So if you're like most people, you probably want to pay less in taxes. But the question is, how do you actually go about doing that?
Well, you know what my feelings are about this. I don't even pay taxes.
Yeah, that's easy when you have no income.
Hi.
Hey,
Hi.
Okay, well, I guess you could quit your job. And if you did that, you'd probably pay less in taxes. I guess this video is done, right?
I can get a job tomorrow in the Air Force. I quit.
Oh, somebody help him out, for God's sake.
You gotta use your lower back.
Okay. No. I'm not encouraging you to quit your job. But what if I did tell you that the amount of tax you pay is completely under your control? See, to a certain extent, you can manage and reduce the taxable income you will have when you get to retirement. And if you want to find out how to do this, you're going to want to keep watching this video. So if you don't know who I am, my name is Jason Kennedy. I'm the founder and advisor for the Kennedy Financial Group. And for almost 15 years, we've been working with families to help them to preserve, save, and grow their money in a tax advantage way so that they can have the cash flow in retirement that they need. Now, to set the tone for this discussion about taxes, I want to share a quote. Here's what it says. It says, "Anyone may so arrange his affairs so that his taxes shall be as low as possible. He is not bound to choose the pattern which best pays the treasury." And get this, there is not even a patriotic duty to increase one's taxes. Now, this ruling was the result of a decision rendered by Judge Learned Hand. And what he made really clear in this particular ruling was that each individual can decide for themselves, based on the choices they make, how much they pay in taxes. And this makes tax planning an essential part of any retirement plan. So in this video, what we're going to seek to accomplish is we're going to explain the progressive nature of taxes. We'll talk about the different accounts you can put your money into to allow that money to grow tax-free. And then we'll give you just a brief overview of how they each work, what the IRS limits for contributions are, and hopefully that'll get you started in this process of trying to manage taxes throughout your working life and into retirement. So let's start by answering the question, how is income taxed? Really, in order to understand how our retirement income is taxed, we need to understand how income is taxed today. Now, we live in a marginal tax system. This means that the tax rate for an individual increases as their income rises. If you notice on the screen, you can see that our tax rates are marginal. It's based on how much income we have. Now, if you just use this merit tax bracket as seen here in this example, we can kind of see how this works. So you probably notice the income is going up. The more income a person has, the more taxes they're going to have. Now, ignoring the standard deduction or any other deductions a person may have, that first $20,500 worth of income is taxed at 10%. Everything between $20,000 and $83,000 is taxed at 12%. Everything in between $83,000 and $178,000 is taxed at 22%, and so on. So if a married couple made $200,000 a year, they would pay 10% on the first 20,000, 12% on the next 60,000, 22% on the 94,000, and 24% on the next 22,000. Now, why are all of these numbers important? Well, it's because withdrawals from your untaxed retirement accounts will push you into potentially higher tax brackets and require you to pay more money in tax. And that's important to understand right now. The second issue is that your income could cause your Social Security to be taxed. Now, as an example of this, the 2022 tax year, 15% of all your Social Security benefits are tax-free. Now, the remaining 85% of the Social Security you get each month is also tax-free as long as your provisional income stays below a certain threshold. Once you begin to make over a certain amount of money in retirement, now your Social Security becomes taxable, even though you might have viewed it as a tax when it came out of your check. So provisional income works this way. If your income is in between 25,000 and 32,000 as a single person, then 50% of your Social Security income is taxable. If your income is above 34,000, then 85% of your Social Security is taxable. Now, it's not much different as a married couple. If your provisional income is between 32 and 44,000 as a married couple, then 50% of your Social Security will be taxable. And if you make more than $44,000 a year, then 85% of your Social Security is taxable. So we really could sum this up by saying that unless you plan to significantly reduce your income in retirement, you could cause your Social Security to be taxable if you do not plan for taxes before you get to retirement. Now, as a side note, no inflation adjustments have been made to those limits. And as a result, most people who receive Social Security benefits and have other sources of income end up paying some type of tax on their Social Security benefits. So the question is, how do we avoid this problem? How do we manage our income so that we don't pay unnecessary tax? Well, we need to learn what counts toward the calculation for provisional income and then learn what does not count toward this calculation for provisional income. So the easiest way to highlight this is just to show you the different taxable buckets. See, on this side, you have everything that's taxed, and on this side, you have everything that's tax-free. Now, all your income from work, your pensions, your 401ks, growth from stocks, brokerage accounts, and 1/2 of your Social Security all come together to count as provisional income. All income from those sources have the potential to be taxed. Now, the sources of income that are not taxed are Roth IRAs, municipal bonds, and life insurance. Each one of these asset classes have the potential to be tax-free upon distribution or access of the funds there. So if you're following me correctly, the key to managing tax in retirement is making sure you have the right amount of money in each account. Too much money in accounts that count toward provisional income could cause you to pay tax. On the other hand, if you can maneuver that money to the accounts that are tax-free, then you can control your income in retirement and you can make sure that you're not paying any unnecessary tax. Now, for the remainder of this video, we're going to focus on the assets that are tax-free. We mentioned 3. We'll focus on 2 of them, the 2 most popular ones, Roth IRAs and life insurance. Now, the Roth IRA allows you to contribute after-tax dollars. And while there are no current year tax benefits to your Roth IRA, your contributions and earnings can grow tax-free, and you can withdraw them completely tax-free and penalty-free as long as you follow the IRS rules. And the IRS basically states you have to leave the money in the account for at least 5 years, and you have to be age 59 and a half to access those funds. If you meet those 2 rules, then all of the money you put into your Roth as well as the growth can be accessed completely tax-free. Now, there is no contribution age restrictions, meaning that you can be as old as you want to be. And as long as you have income, you can put money into a Roth IRA. They'll never say you're too old to make a contribution. As I already stated, your access is limited in your account until you reach age 59 and a half. You can withdraw all the money that you put into the account tax-free, but if you need to access your growth, the money you've made inside the account, then you could be charged a penalty if you access that before retirement. And they would also require you to pay tax on the money that you've made. Now, there are some exceptions to this rule. For example, if you're a first-time home buyer, you could get some access to your account, and there are other rules that allow you access. Another nice benefit of the Roth IRA is that there is no required minimum distribution. See, RMDs, as they are also called, are a required distribution that the government asks you to take once you get to a certain age because they want the tax revenue. But because Roth IRAs are tax-free, there's no requirement to take money. This allows your savings to continue to grow during retirement. And if you desire to leave some of those assets to your children, you can do so. There are no income taxes for inherited Roth IRAs. If you pass this Roth IRA on to your heirs, their withdrawals will also be income tax free. Now, how much can you put into a Roth IRA? Well, the maximum amount that you can put into a Roth IRA in the year 2022 is $6,000. If you're under the age of 50, if you're over the age of 50, you can put $7,000 into a Roth IRA. If your income is over a certain amount, they limit your ability to contribute to a Roth IRA. Once again, once a person makes too much money, then they do not want you to be able to experience those tax benefits. The amount you contribute is slowly reduced until you can no longer put money into the Roth IRA. Now, another thing to be familiar with is depending on the way you file your taxes, you could disqualify yourself from a Roth IRA. I was working with a client, and for personal reasons, they had to file their taxes married, filing separately. And as a result, they couldn't fund a Roth IRA. Once you make over $10,000 in that situation, you can no longer put money into a Roth IRA. But that only applies to that unique tax filing. So we've talked a little bit about how the Roth IRA works. Let's talk about how life insurance works, since that's the other place you can go to place money in a tax-free environment. Now, life insurance, when it is properly designed, it can be used as an additional place to store cash in an environment that can be accessed tax-free. Remember, life insurance, for the most part, has been designed to replace income when a primary breadwinner passes away. And as a result, there is no tax on death benefits that are passed to beneficiaries. So widows, orphans, and struggling businesses who receive this infusion of cash when a key person passes away, they do not have to pay tax. Now, this tax-free access to cash also applies to the money that's growing inside of your life insurance policy. So when a life insurance policy is designed to grow cash, meaning you squash the death benefit to the lowest amount the IRS will let you squash it to, and you put in as much extra cash as the IRS will allow you to, then that money is able to grow on a tax advantage basis. Now, you're able to aim for a growth rate that is in the high single digits to possibly even double-digit rates of return. Now, I'm not saying that you should expect to get double-digit rates of return every year on a life insurance policy, obviously, because you're not taking on the same risk that you would be by putting your money in the market. You shouldn't expect the same rate of return. I'm just simply stating the fact that you have the ability, the potential to get higher rates of return than you would get if your money was maybe sitting in your bank account, maybe connected to a bond asset. You can average higher rates of return than other fixed asset classes. Now, the money that grows inside these accounts is tax deferred, and it can be accessed tax free. You also have access to the cash inside of your life insurance policy throughout the life of your account. So if you need money before retirement, you can access it. You also have the ability to use your death benefit as collateral for a loan from the insurance company. This means if you need an infusion of cash during your working years, you can let your money continue to grow uninterrupted and use the life insurance company's money. Now, just like with the Roth IRA, there are rules and restrictions that govern how much you can put into a life insurance policy. And the IRS basically ties those rules to the amount of life insurance you have. Each dollar of life insurance you have grants you a certain amount of cash that you can put into your policy. There are no contribution limits, so that makes it different from the Roth IRA. You can put into your policy as much money as you desire, as long as you can support the life insurance benefit that is attached to it. There are no income restrictions. So a person can never be told that they make too much money to put money into life insurance. And so a lot of high income earners who cannot contribute money to Roth IRAs may look to life insurance as a potential option for some of their cash that they want to grow on a tax-free basis. So let's see if we can bring all of this home. All right. So just imagine a retired person, they're married, and they have $30,000 in Social Security together. That's their Social Security each year. Now, they know that $15,000 of that Social Security, one half of it is going to count as their provisional income. That means that they need to leave just enough money in their 401k to withdraw maybe another $10,000 a year. Now, why does this all matter? Remember, if they have too much money inside of their 401k, then they will be pushed into a higher tax bracket as they try to withdraw the money needed to meet their living expenses. This could cause them to pay taxes on more money than they need to, and it could also cause their Social Security to be taxed. But as I stated earlier, in this example, the person only withdraws $10,000 from their 401k. That will push their provisional income to $25,000. Everything else should come from tax-free sources. Now, like I mentioned earlier, to keep this simple, I'm not including deductions, things you may write off, nor am I including the standard deduction. Obviously, with the standard deduction, there may be a little bit more wiggle room. The lesson that I'm trying to emphasize in this video is that there is a mathematical amount of money to have in each type of account, in your taxable bucket, your tax deferred bucket, and your tax-free bucket. The goal should be to have the right amount in each of those buckets so that you can manage and control taxes. If you have the right amount in the taxable buckets, then everything else you withdraw in retirement will come from a tax-free income source. This means that you will pay $0 in taxes on all of the money coming from those tax-free income sources. So how do we recap everything that we've talked about in this video? Well, number one, the more income you make, the more you pay in taxes. That is the way our income tax system is designed. Number two, the key to managing taxes in retirement is having a basic understanding of the three different tax buckets and ensuring that you fund each one properly. Number three, there is a mathematical amount of money that should be in each bucket if you want to control your income tax in retirement. And then finally, number four, it is absolutely possible to eliminate, reduce, or alter the amount you pay in taxes, and there is nothing wrong with doing so. You have the right to determine it for yourself. If you liked this video, if you appreciated the content, give us a like, subscribe to our channel, share the video with a friend. Let us know you appreciate what we're doing in the comments so that we can continue to make content to help. Now, if you need my help doing this type of planning, we're specialists in showing our clients how to convert assets to a tax-free position, how to take money that they want to see grow at a safe and productive rate of return and put it into an environment where it can grow tax-free and you can access it tax-free. If you need my help with that, feel free to reach out. Until our next video, until the next time we talk, take care.